Let's move from autos now to the entire AI opportunity. And we've got Sanjeev Verma, the ED and CEO at Black Box, joining in on the show right now to talk about exactly that. Sanjeev, hi, morning. Welcome to ET Now. Sanjeev, data centers, they're receiving clearly a lot of support now from the government as well. As seen in the budget, it's even a major theme in the AI summit now currently underway. Tell me, how is it that it's helping you specifically at Black Box?
Well, of course, it's helping us. You see, when government recognition for data centers is, of course, accelerating investments. Investments in AI infrastructure requires, a lot of robust, secure facilities. We believe the overall impetus that the government has put behind this place will. We expect to see a larger pipeline, larger deals. A lot of hyperscalers are expected to come in and invest. So all in all, I think it's a structural shift. I think the investments in that space will dramatically change and improve. And from Black Box perspective, clearly we expect to see a larger pipeline, better engagements. We have been supporting and partnering with a lot of hyperscalers overseas. With the investments in India and the recent AI summit, I expect this is a game changer. I think this will transform the industry. A very good move, and we expect to see a better pipeline, larger scale of business, better engagements with our customers, both locally in India and worldwide.
To that, given that everyone is partnering now with players such as NVIDIA, OpenAI, Anthropic, shed some light on the kind of partnership ecosystem that is emerging for you, and if any new collaborations have already sort of been signed up.
Okay, so specifically, Black Box, we play in the digital infrastructure space. Of course, if you look from a ecosystem perspective, there are hyperscale infrastructure providers from a GPU perspective. And then, of course, you talked about Anthropic and others from the model perspective. So for a model to work, you require infrastructure. So we partner with networking, connectivity players, compute players. We provide secure infrastructure for the model to run. We continue to evaluate our partnerships as to how we evaluate from here. So it continues to change as you see some of the larger players emerging. But clearly, from creating a robust networking, secure infrastructure, connectivity, that's where we play. That's the backbone of AI models to work. We collaborate with some of the largest players in that space, and we expect to evaluate the collaboration as we move forward to see what makes sense for us. It is a rapidly changing space, as you know, right? So I think we continue to evaluate that, but clearly excited about what's coming. I mean, it's not a yearly affair anymore, not even a monthly affair. It's becoming a weekly affair. So we're watching it closely, but excited about the opportunity to partner, collaborate from where we are, from where we want to go.
Okay, Mr. Verma, hi, morning. Just to put some numbers on this conversation, your global solutions integration segment now contributes 84% of your portfolio. How much operating leverage can kick in further as the data center execution scales?
So clearly, it will provide us with a lot of leverage. I mean, scale brings leverage, right? So I think we expect our absorption of fixed cost to be much better at scale. And if project execution happens to be on time, we expect the margins to improve. So without giving a specific number, I think we believe this, from an overall perspective, we should be able to push a couple of 100 basis points northwards as we start to see some scale. So clearly, scale is a game changer for us from that perspective. The absorption of fixed cost, better efficiency, a better operating margin was an outcome of getting scale with the data center investments coming in, which we, from our perspective, is a large play for us going forward for the next several years.
Okay, and also while we're talking about financials and trying to quantify this, you've reduced your revenue, EBITDA as well as PAT guidance for FY26 in Q3. Help us understand what has led to this. Was it mostly due to an expected increase in the order backlog? And if so, then what has caused this backlog?
So I think in general, it's a timing shift and not a demand softness. With so much hyperactivity, there have been certain challenges pertaining to experiencing delays in some project milestones. So the revenue has shifted from the Q4 for the forthcoming quarters going forward. So I think the guidance that we provided now is more realistic from a perspective of not demand, which of course our order books are much larger. We closed better, we booked more orders. We expect to open up a larger order book at the beginning of fiscal 27. So a timing issue, some project delays, some milestones, some execution issues at the customer end has pushed the revenues from now to subsequent quarters. We still see very strong demand. Order books are stronger. We expect to open up a larger order book and start the fiscal 27 on a very positive note.
Well, FY27 is expected to start on a very positive note, and that sounds good. Mr. Verma, let's talk about your recent acquisition. You've recently announced the acquisition of 2S, which is your play on the Latin America geography, if I understand correctly. Your revenue share from that area, Latin America, is only about 3%. Talk to us about how will this 2S acquisition change that, and by how much?
So first of all, we believe LATAM to be an important market. More specifically, Brazil has a lot of potential with digital infrastructure. I think so. We believe our presence out there needed some scale. You're right. We were a subscale at 3% out there. So we expect over the next several years to become a significant player. In the forthcoming year, we expect our contribution from LATAM move from a current 3% to close to 7-8%. And of course, from there, we intend to grow our LATAM presence from Brazil, going deeper, then wider into the other adjacent markets in the LATAM. So from 3%, we expect to 7-8% in the coming year and take it from there to scale up from there.
And Mr. Verma, let's talk about your order bookings. You've booked about $626 million, to be exact, in the 9 months of the financial year so far. You've been targeting $1 billion for FY26 overall. How confident are you of closing this gap in Q4, given that now there's less than a month, or in fact, slightly more than a month left for this quarter to culminate? How has Q4 begun in terms of order booking, if you could throw some light there?
So first and foremost, we remain confident to get to our $1 billion goal. I think, as I said earlier, I think we have a stronger backlog. The pipeline remains strong. Large deals are often towards end of the quarter cycle. The quarter has started fairly strong from that perspective. And in the middle of the quarter, we remain fairly strong to meet our booking goals for the year to be a $1 billion. Our momentum remains high. And with all this infrastructure investments becoming sooner than later, the AI adoption, I think it helps us. So yes, we remain confident for $1 billion. And I think that's where our guidance is at this time. Opening up the fiscal year 27 at a fairly stronger note at nearly about $800 million of backlog getting into the new year. So remain confident, yes.
Okay, good to hear that, Sanjeev, and good luck for the future as well. Thanks for your time today.
Thank you so much.
Okay, on that note, let's take a very quick break. Just want to quickly revisit what the markets as well have settled in at. While sure enough, it's a little bit of a soft start after that painful yesterday. And we now seem to have recovered some amount of ground, at least 26,500, 25,500 is back on the ticker. And a big turnaround in the markets led by Coal India, BEL, ONGC, L&T. They are the leadership names this Friday. Hindalco, Nestle, ICICI Bank, Axis, Reliance Industries has perked up 0.5% higher. So that's the piece of the market which is giving it that leg up. IT, of course, continues to be languishing. We'll take a very quick break, come right back for more.